Namaskar. I welcome all of you to my YouTube channel Agri Business A Journey. Today I will discuss about inflation. Inflation means too much money chasing after too few goods. In this context, inflation has been categorized into two categories. One is the demand pull inflation, second is the cost push inflation. Demand pull inflation means there is the increasing in the demand of different type of the commodity in a particular country. Cost push inflation means there is the increasing in the factor cost. Increasing the factor cost or input cost will increase the price of a particular commodity in a country. That is called as the cost push inflation. Let's describe about demand pull inflation. Demand pull inflation has been categorized into different type of the points. One important point is that increasing in the money supply. If the government is thinking about the growth of a particular country or the growth cycle is at its expansion stage, then more and more money will coming to the market. If more and more employment will be observed in a particular system, or there is the chances of full employment in a particular country, then also money supply will be increased in a particular country. When the money supply will be increased, then more and more product will be demanded. In absence of proper supply, then it will be add inflation. Second element is that increasing in the disposable income. You all know that when the interest rate will be decreased down or government will give tax exemptions to the consumer, then consumer will find more money in its pocket. When more money will come to the consumer's pocket, then demand for different type of the commodity also been increased. In absence of supply, it will add inflation. Third is increasing in the population. You know that when the population will be increased or the population growth rate will be increased, more and more consumer product and the capital product will be increased. The demand for the consumer product will be increased and demand of the capital product also being increased. If the supply is very poor, then it will be add inflation. Saving and investment. When our income generation will be increased, then it will be increased our saving and investment. When the saving will be increased, when the investment will be increased, then automatically you will see the more and more money will coming to the market. All these are the integrated to each other. In that context, if the supply is very poor, then automatically it will be add inflation. Numbers of times you will see the speculations. Speculation means if some of the entrepreneurs or the private players expecting the increase in the price of a particular commodity or expecting the increase in the demand of a particular commodity in future. In that context, they hold the commodity under their control. In that way, it will be increase the price of the commodity, and in absence of proper supply, then definitely you will find the inflation. Let's go back to the cost push inflation. Suppose there are very few capital in a system or in a country. Few capital means automatically your supply will be less. Your supply of the product will be very less. When the supply will be very less, then per unit cost to produce a particular product will be very high. If the per unit cost to produce a particular product will be very high, then it will be increase the price of the product. If they increase the price of the product, then it will be add inflation or it will be create inflation. Second is the decreasing in the complementary factor of production. Complementary factor means suppose there is a tractor. To run a tractor, you need a very skilled driver. Suppose tractor is here, tractor is there in the farm, but driver is absent, then automatically due to the absence of complementary product, your supply also be reduced down. When your supply will be reduced down, then per unit cost of every factor will be increased and ultimately price of the product will be increased. That is called as the one of the element of the cost push inflation. Third one is the increasing in the prolonged industrial unrest. Suppose there is a very less raw material available for a particular industry, or you know that maximum time trade union going for the strike. In that condition, industry will not produce as much as supply for a particular country. If they will not produce, then ultimately their cost for different type of the factors or the input would be increased and the price of the product will be increased. Price of the product, if it will be increased, then it will be going for the stages of inflation. The next category is the due to the increase in the export and decreasing in the import. Suppose you are producing a product and export the same to the different type of the country, and simultaneously you will not import the things to satisfy the country populations. In that context also, your supply or stock limit in a particular country will be decreased down. Then ultimately your price of the commodity will be increased. Numbers of times, due to the increase in the natural calamities, your supply, whatever you have produced, it will be going down. Then ultimately your price of the product will be increased. That is called as the cost push inflation. Then I have given that one condition is the hyperinflation. Hyperinflation occurs, suppose you all know that in a particular country resources has been managed by either by the government, either by the public, either by the private or by the entrepreneur. Suppose whatever the resources are there, if they are not being used or utilized properly, then ultimately due to the escalating effect, you will find the inflation will be increased in a particular country. That is called the hyperinflation. One category is the oligopoly. Numbers of times you see there is not so much increasing the aggregate demand, but there is a cartel system, there is the informal group system, or there are very few players who supply a particular commodity. You know that the petrol, diesel, fertilizer, these products has been handled by very few players, very few suppliers. According to their wish, they increase the price of the product. In that conditions, you also find that inflations. And how you control that? How you control their behavior? Due to their administrative price management system. You control through the government. Government will impose that you could not increase the price of the product at anyhow. If the government will interfere in their price mechanism, then and then only their inflation will be reduced down. Another most important parameter is that compositional inflation. Compositional inflation means, suppose just for the example, there is the food grain, automobile, real estate, these type of the commodity, FMCG products, these are the commodity are there. Numbers of times the demand of the automobile will be increased. Whatever the money consumer has, the demand of the automobile will be increased. But that doesn't mean that similarly FMCG product will be increased, or the food grain will be increased, or the real estate will be increased. If one category of the product will be increased, then government will interfere through their monetary policy, through the central bank institutions or the central bank or the Reserve Bank of India, by which it will be control over one category of the inflations in a particular country. In this way, I will describe about monetary and the fiscal policy or different type of the control measures of inflation in my next video. Stay tuned with me, and thank you for watching this video.